While transaction activity has remained slow for REITs, they have demonstrated their resilience during a very tumultuous market environment and do appear to be positioning themselves for some accretive growth opportunities. So I am cautiously optimistic that we'll see an uptick in activity, if not by the end of 2025, then hopefully for 2026.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. My guest today is Stacey McEvoy, partner at global law firm Hogan Lovells. Stacey has extensive experience advising REITs as well as other real estate companies in complex transactional matters and is with me to discuss key issues and trends for the REIT industry today. Stacey, welcome to the podcast.
Hi, thank you, Sarah. Very nice to be here.
So, Stacey, first of all, how have REITs held up so far in 2025 amid market volatility and lots of uncertainty? And what are your expectations for the remainder of the year?
It's a good question. I mean, there have definitely been some sharp swings in 2025. We've seen initial gains early on in the year, followed by declines, and then a rebound in about the mid-second quarter. And REITs have generally demonstrated resilience during the first half of 2025. In particular, those REITs that have maintained disciplined balance sheets have been the most successful at navigating the market volatility. Of course, there have been the changing trade policy with tariffs and counter tariffs, and that has had an impact on real estate generally. But those, fortunately, were not as pronounced as had been expected. For the remainder of the year, I'm not expecting a dramatic change. However, I do think the modest positive performance that REITs have experienced during these uncertain times have left them well positioned to achieve stronger performance in 2026 as the markets stabilize.
Stacey, to what extent have real estate valuations been impacted by market fundamentals, and what effect is that having on transaction activity today?
There is still a very wide valuation gap, but it has been narrowing, leading to greater stabilization, but that recovery has been uneven. The market's continuing to feel the effects of the high cost of capital from the last couple of years, along with higher cap rates. Although those have been declining, investor sentiment remains cautious. As a result, transaction volume has been down. Public REIT M&A has generally been slow in the first half of 2025, which follows a relatively slow 2024 for REIT M&A as well. So we're not looking at the activity that we saw in 2021 through 2023, where there were 10 plus deals each year that were announced. On the other hand, REITs have been active in capital raising, particularly through the debt capital markets. So while the lack of M&A deal activity points to continuing valuation gaps and ongoing strategic caution, the capital raising could be a positive sign that REITs are positioning for growth opportunities.
Stacey, in the past, we've spoken about joint ventures. Do you think that they are still an attractive option for REITs today? And really, what are both sides looking for in a JV deal? And what are the ingredients of a successful partnership?
Yes, joint ventures are definitely still something that a lot of REITs are looking carefully at. It really depends on what you're looking to achieve by using the JV vehicle. They can be attractive for a variety of reasons. They're a lower cost of capital compared to prevailing interest rates, for example, to fund the development of a new project. They can offer the ability to monetize assets without having to dispose of the asset or incur additional debt. And in some cases, they can offer an alternative method to incentivize partners. We see them a lot of times used as a strategic tool to recycle capital, diversify and rebalance portfolios, and scale platforms. So in a JV where a REIT is bringing in third-party capital as a partner, that capital partner is going to want provisions that protect its investment and anticipated return. Because at the end of the day, the attractiveness for the capital partner are those risk-adjusted returns and the steady cash flow that they generally expect to receive in a real estate JV. So they're going to look for things like parameters on how a REIT manages the venture, standard of care, for-cause removal rights, and then certain major decision rights that help them feel comfortable that the asset is going to continue running smoothly. The REIT is typically interested in maintaining control of the asset, subject to those limited major decision rights of the capital partner, and ensuring a smooth exit process. So the most successful JV is one where both parties feel valued, have their interests represented, and there's a consultation and communication on significant matters.
Are there certain REIT sectors that are more active when it comes to acquisitions, dispositions, JVs today? And how does that compare with what you've seen in recent years?
Industrial REITs, data center REITs, healthcare REITs, and the single family rental REITs in particular have continued to be active. And that's consistent with the strong performance that they've continued to demonstrate. A little bit more unexpected, retail has also been actively acquiring in the first half of 2025. I'd say this is pretty consistent with recent years. Data centers in particular shouldn't come as a surprise, given their utility is driven by the heightened AI infrastructure demand and the hyperscale tenant expansion. And it doesn't seem like that's going away anytime soon. And then similarly, the aging population and demand for specialized facilities has healthcare REITs continuing to have activity as they've been on the rise for some time. And then the single family rental REITs have also continued to scale their portfolios over the last few years, which leads them to still be active in the acquisition space in particular.
And Stacey, another area of your expertise involves baby REITs. First of all, can you explain what they are and the issues that surround share sale transactions?
Sure. A baby REIT is really just a subsidiary entity that has elected to be taxed as a REIT. You see this most often in a joint venture transaction because there are certain types of foreign investors that may have significant tax savings if dispositions are structured as a sale of the REIT shares as opposed to the sale of the underlying asset. Given that, those foreign investors negotiate for this sort of exit structure at the outset. What that presents, though, in the JV construct are some additional deal considerations when you go to sell the asset that don't exist in an asset transaction. In this circumstance, the buyer is now acquiring a separate legal and tax entity that owns the assets. So a buyer could consider that a riskier proposition because they are taking on historical entity liabilities. As a result, they're likely to look to protect themselves in various ways that you don't otherwise see in a transaction that's just accomplished through a deed transfer. So you see things like representation and warranty insurance and a REIT opinion, and then some additional indemnities that may get negotiated in those deals. There's also increased cost associated with a baby REIT transaction because you have to now diligence the entity as well as the REIT status of the entity. So a buyer may look to get various credits, including for the additional transaction costs associated with that structure, the diligence that we just talked about, if there are different transfer taxes, the cost of the rep and warranty insurance, as well as the cost of any post-closing REIT maintenance and other tax-related costs.
And Stacey, what would you say are some of the most important legal and regulatory challenges that REITs are facing today?
That's a big question given the developments. We've had a lot happen in the last 8 months or so. So I probably need to start with the executive orders that were issued by the Trump administration on ESG and DEI matters. Most REITs would have already undertaken a review of their company's policies and programs to ensure compliance with the current law earlier this year. It is important in this environment to continually assess your company's culture and values and how you continue to navigate these matters, including messaging with your employees and the actions you take. There are also market drivers that remain in play that you have to keep in mind, particularly from a sustainability viewpoint, because those will continue to influence how you operate. Foreign investors, for example, generally still have a focus on ESG matters. Another topic of foreign investors that impacts how they come in are changes in tax policies. So that may impact the desirability of a foreign investor making investments in the US and then could have adverse implications on REIT returns. Risk management is another key area for REITs, especially as it relates to data and cybersecurity, because the reliance on digital platforms continues to grow. This has and continues to be a growing risk as more REITs are facing sophisticated cyber attacks. And as a result, it's important for REITs to consider data security policies and procedures and procure cyber insurance. Finally, while not unique to REITs, the use of artificial intelligence continues to be a hot topic. REITs are probably a bit behind other sectors when it comes to the use of AI, but as AI tools continue to proliferate, usage is something that we are continuing to hear a lot of REITs considering. So with that comes considerations around the policies associated with the use, regulatory risk, and how it will actually be effective in your business.
Excellent. Stacey, we've covered lots of ground, but anything that we've missed that you think our listeners might be interested in?
I think it's really just worth reiterating that while transaction activity has remained slow for REITs, they have demonstrated their resilience during a very tumultuous market environment and do appear to be positioning themselves for some accretive growth opportunities. So I am cautiously optimistic that we'll see an uptick in activity, if not by the end of 2025, then hopefully for 2026.
Great. Stacey, thanks so much for your time today.
Thank you very much, Sarah. I appreciate you having me on.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.